Welcome. Today we'll show you how to stop overpaying taxes throughout the year, keep more cash in every paycheck, and put that money to work. We'll focus on using the IRS tax withholding estimator and optimizing your W-4, especially Step 3 for credits, to reduce or eliminate large refunds. To begin, here's what we'll cover. In this video, we'll first explore why large tax refunds are a sign of overwithholding. Next, we'll walk through a simple W-4 strategy that increases your monthly cash flow. Then, we'll show how to reflect child and other dependent credits right away, not at year-end. After that, we'll demonstrate how to use the official IRS withholding estimator to avoid guessing. We'll also discuss where to direct the extra money, how to avoid penalties, and finish with quick quizzes to reinforce learning. Now, before we dive deep, a brief but important disclaimer. This video is for educational purposes only and does not constitute tax, legal, or financial advice. Your situation is unique, and laws can change. Consult a qualified tax professional or financial advisor before making changes to your withholding or investment strategy. With that said, let's understand the core problem. A large refund indicates that you overpaid your taxes throughout the year, effectively lending the federal government your money without earning interest. That cash could have been increasing your savings, paying down debt, or compounding in investments each month. Instead of a windfall at year-end, aim for steady, optimized cash flow in every paycheck. Next, let's break down the cost of overwithholding. Overwithholding reduces your monthly liquidity, which is especially harmful during inflationary periods. The funds you send to the IRS could instead be invested regularly, capturing compounding over the year. Relying on a once-a-year refund creates volatility in your financial management and can lead to impulsive or unplanned spending. The goal is to shift from an annual refund to consistent monthly cash flow aligned with your financial priorities. Now that the problem is clear, let's introduce the solution: a smarter W-4 strategy. A smart W-4 strategy aims to reduce or eliminate your expected refund by aligning your withholding with your actual tax liability. Using Step 3 to reflect credits like the child tax credit means you receive more of your money during the year. The key is to be precise and disciplined. Next, we'll walk through exactly how to do this using the IRS withholding estimator. First, visit the official IRS tax withholding estimator. Next, gather your most recent pay stub and last year's tax return. Then, carefully input your filing status, number of jobs, income, adjustments, and credits. Be sure to include dependents and credits like the child tax credit. After that, review the estimator's specific suggestions for W-4 steps 2 through 4, paying close attention to Step 3 for credits. Next, submit an updated W-4 through your employer's payroll portal, or HR. Then, verify the change by checking the next 1 or 2 paychecks. Finally, rerun the estimator after any life changes such as a new job, raise, or family changes. With the estimator process clear, let's visualize the optimization path. This flowchart begins with your current paycheck and asks if you're using the IRS estimator. If not, you face the risk of over or under withholding, so the next step is to use the estimator. If yes, you input income, dependents, and credits. Then you review specific W-4 steps. Step 3 for credits, Step 4A for other income, Step 4B for deductions, and Step 4C for any extra withholding needed. After updating your W-4 with your employer, you check the next paychecks to confirm the change worked. Finally, you revisit after life changes with the goal of a near-zero refund while avoiding penalties. Now let's focus on maximizing credits immediately. Use W-4 Step 3 to claim eligible credits, such as the child tax credit and other dependent credits, so your paychecks increase during the year. For example, if your refund historically runs around $6,000, that equates to roughly $500 per month, or around $230 per biweekly paycheck. Direct those funds immediately toward high-yield savings, investments, or retirement contributions to capture growth. Remember, credits can be subject to income phase-outs and other eligibility rules, so reassess annually or when your situation changes. Having seen how credits improve cash flow, let's compare approaches side by side. On the left, a big refund provides a once-a-year windfall but represents an interest-free loan to the government. It can create budgeting volatility and may lead to impulsive spending, while missing compounding opportunities during the year. On the right, optimizing your W-4 leads to steady, larger paychecks. Your money works for you sooner, supports a smoother budgeting rhythm, and increases the potential for investing and debt payoff. Overall, the optimized approach is more efficient and intentional. With that in mind, let's decide how to allocate the extra cash. Automate transfers on payday so the extra cash is directed immediately and consistently. A simple priority order is to build or top off your emergency fund, pay down high-interest debt, and then increase retirement and investment contributions. Consider tax-advantaged accounts first, such as capturing your full 401k match, contributing to an HSA if eligible, and funding an IRA or Roth IRA as appropriate. Using separate sub-accounts can help prevent accidental spending. Before we move on, let's lock in the learning with a quick quiz. Question: why is a large tax refund generally not a financial win? Options: 1. It means you perfectly optimized your withholding. 2. It indicates you gave the government an interest-free loan all year. 3. It guarantees you paid the least possible tax. 4. It ensures you won't owe penalties. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that it indicates you gave the government an interest-free loan all year. A large refund generally means you over-withheld and could have used that cash during the year to save, invest, or reduce debt. Now, let's reinforce how to implement the fix via credits and the IRS estimator with one more question. Question: which W-4 step most directly reflects eligible credits like the child tax credit into your paycheck during the year? Options: Step 2, multiple jobs or spouse works. Step 3, claim dependents. Step 4, A, other income. And Step 4, B, deductions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Step 3. Claim dependents. This step communicates eligible dependent credits, such as the child tax credit, to your employer, allowing your withholding to adjust during the year. With quizzes complete, let's cover penalties and discipline to keep your strategy safe. It's essential to avoid underwithholding that could lead to penalties. Use the IRS withholding estimator rather than guessing. As a general framework, many taxpayers avoid penalties by meeting safe harbor rules, paying at least 90% of this year's tax, or 100% of last year's tax, or 110% if prior year adjusted gross income exceeded certain thresholds such as $150,000. Verify current rules on the IRS site or with a professional. With the risks in mind, here are common pitfalls to avoid. Avoid guessing when updating your W-4. Use the IRS estimator for precision. Don't overlook Step 3 or the possibility of phase-outs affecting your credits. Revisit your withholding after events like raises, job changes, or family changes. Make sure increased cash flow is directed automatically toward your goals to prevent lifestyle creep. Also, remember that state withholding may require its own adjustments. To visualize your new rhythm, let's look at a timeline. This timeline shows the process from running the IRS estimator to submitting an updated W-4 in the current pay period. Over the next 1 to 2 paychecks, you verify the increase in net pay and make any required tweaks. Each month, automated transfers move the extra funds to savings, investments, or debt payoff. Quarterly, you rerun the estimator if anything changes. At tax time, the goal is a small or no refund without penalties. To consolidate the learning, here are the key takeaways. Key takeaways. First, large refunds signify an interest-free loan to the government. Second, always use the IRS withholding estimator rather than guessing. Third, reflect credits immediately via W-4. Step 3, to increase your paychecks during the year. Fourth, automate the additional cash toward your goals. Finally, recheck withholding after life changes, and be mindful of safe harbor rules to avoid penalties. Next, here's a quick markdown cheat sheet you can screenshot. This is a simple markdown cheat sheet. The action plan is to run the IRS withholding estimator, update your W-4 with emphasis on Step 3 for credits, automate transfers on payday, and review quarterly or after life changes. Targets include aiming for a near-zero refund while avoiding penalties and directing funds to a high-yield savings account, investments, and retirement. To wrap up, let's summarize and send you on your way with a clear next step. In summary, stop over-withholding and reclaim your monthly cash flow. Use the IRS withholding estimator to calibrate your W-4 accurately. Leverage Step 3 so credits increase your paycheck during the year. Automate the added cash towards savings, investing, and debt payoff. Review periodically to stay aligned with safe harbor rules and avoid penalties. Finally, here's your call to action. Thank you for watching. If this video helped you, please like, share, and subscribe in the comments. Share how much extra cash you expect to reclaim each paycheck after updating your W-4. Your story can motivate someone else to take action.